Welcome back to the deep dive. So you handed us the full stack on Planet Fitness, ticker PLNT. We've got the Q3 2025 earnings call transcript, the flurry of broker notes that followed, and of course the trading data, which was just chaotic.
Yeah, and our mission is the same as always, to slice right through all that noise and pull out the essential signals, the insights you actually need to understand where this business is headed.
And what a trajectory. I mean, this report dropped pre-market and the reaction was, it wasn't subtle.
Not at all. It was an immediate, massive repricing. The stock shot up over 12% on something like 2.5 times its normal volume. So the market is screaming bullish here, and our job is to figure out exactly why. What in these documents sparked that much excitement?
Okay, let's unpack it. Let's start with those headline numbers that just lit the fuse, because this wasn't just a small beat, was it? This was a signal of a real material change.
It was a huge surprise on the bottom line. Adjusted earnings per share came in at 80 cents. Now, the consensus on the street was hovering somewhere between 72 and 73 cents.
Wow.
Yeah. So we're talking about a 10, maybe 11% surprise. That kind of outperformance, it doesn't just happen by accident.
And the top line was there to back it up. Revenue came in strong.
It did. $330.3 million. That was nicely ahead of the, call it, 323 to 325 million consensus. That's a solid 13% increase year over year.
But the engine, the real driver, has to be that same store momentum.
Incredibly healthy. System-wide, same club sales grew by 6.9% overall. And if you peel that back a layer, the franchise comps were even stronger, up 7.1%. It just shows that the asset-light model is firing on all cylinders.
That 6.9% is really the bedrock of the whole bullish case, but let's do the deep dive here. How did they get that growth? Because this feels like the single most important takeaway from the entire call.
This is where it gets really, really interesting for the long-term story. Management was explicit. They said approximately 80% of that Q3 comp growth was driven by rate. Pricing, not just net membership growth. And this is such a crucial point. For years, Planet Fitness was just the $10 gym, all about volume. Now, they are proving they have massive pricing elasticity. They can raise prices and people will pay it. That's the mark of a mature subscription business.
So they're actively shifting that value proposition. It's not just we're the cheapest, it's we provide enough value to justify paying more. And that flows right to the bottom line, which I assume is why the margins look so good.
Exactly. They just executed perfectly on profitability here. Adjusted EBITDA hit $140.8 million. That's up over 14% year over year. And it pushed their adjusted EBITDA margin to 42.6%.
So for listeners who might not track this daily, what does a 42.6% margin mean in this context?
It means they're incredibly efficient. That number is up about 50 basis points, so half a percentage point from last year. And you asked how an asset-light business does that.
Yeah, what's SG&A control really mean here?
Well, look, since the franchisees are the ones paying for the club build-outs and the local operating costs, the corporate entity PLNT can keep its own overhead, its SG&A, incredibly lean relative to its revenue. So as those franchise fees come in higher, it creates this huge operating leverage. The corporate structure scales without massive new costs.
And you can't talk about margins without talking about the Black Card. That's their cash cow, and it just keeps getting bigger.
It's staggering. Black Card penetration is now at 66.1%. That is up 300 basis points, a full 3 percentage points from just last year. Management keeps stressing this isn't just about volume. They're getting higher value members who use the clubs more and critically stick around longer.
Right. So you combine that mix shift with their lean operations.
And it's no wonder they ended the quarter with nearly $600 million in cash and felt confident enough to buy back $100 million of their own stock. It's a huge signal of confidence.
Okay, this is where it gets really interesting for me. Let's move from the Q3 results to the future, the strategic roadmap. Management is talking about a golden age of fitness, and the biggest tell for future revenue is that they confirmed another big price hike for the Black Card.
Yes, this is definitive. The price is going up from $24.99 to $29.99. But the timing here is key. It's not happening until after the 2026 peak join season.
Ah, so they have a full year to roll out new stuff to justify it.
Precisely. You can't just slap a 20% price increase on a membership without adding value.
And a 20% increase that's a serious hike, especially for their customer base. What are they actually adding to make $29.99 feel like a good deal?
It's a two-pronged approach. First, the premium wellness experience. They're piloting things like dry cold plunge and red light therapy, stuff you'd normally find at a much more expensive boutique studio.
Okay.
And second, they're beefing up the core product. They confirmed close to 80% of their gyms will have updated floor plans with more strength equipment by the end of 2025, as a direct nod to Gen Z and younger members who are all about strength training.
That sounds smart. It all supports the higher average unit volume, or AUV, they're projecting. But hang on, I have to push back a little here. They also mentioned that member attrition is still elevated. People are leaving at a higher rate. How can they raise guidance so dramatically if their churn is high? Isn't that a contradiction?
That's a great question, and it was the one yellow flag every analyst was pointing to. Management had a clear answer, though. They said, yes, it's elevated year over year, but it's actually consistent with historical, pre-pandemic norms.
So it's just normalized.
It's normalizing. And they said it even started to moderate late in Q3. But the crucial part is this. They stressed that this higher churn is already fully baked into their new, much higher guidance.
Ah, okay. So they're basically saying, we see it, we've priced it in, and the growth from pricing more than covers it.
Exactly. It makes the guidance hike much more credible. And it ties right into the other huge structural change they announced for 2026, which is all about marketing.
Right. This is the big one. They're trying to use marketing to fight that churn.
This is probably the most forward-looking thing they talked about. They are taking about 1% of system-wide revenue, roughly $45 million, and moving it from local franchise ad funds into one big national fund.
And that $45 million is going to be used for what exactly?
For centralized, highly sophisticated digital and AI-driven marketing. We're talking CRM, creative testing, the works. The goal is to shift the brand perception away from just being the GOP gym and create a deeper emotional connection.
Which should, in theory, make people stick around longer.
That is the long-term play. It's about efficiency and stickiness. Instead of 1,000 different local ad buys, they're betting that one big, smart, data-driven machine can lower their customer acquisition cost and, more importantly, proactively reduce churn before it happens.
Interesting. Okay, let's pivot to the growth funnel. New locations, new members. How's that pipeline looking?
The unit expansion is still very disciplined. They opened 35 new clubs in Q3, which brings the total to just under 2,800, and they confirmed their full-year guidance of opening 160 to 170 new clubs. They seem very confident they'll hit that.
And they're filling those clubs with younger members, thanks to that high school summer pass.
Oh, it's a massive top-of-funnel strategy, and it's working. Participation was up something like 30% this year to 3.7 million teens. That's over 19 million workouts logged by high schoolers.
Wow. And the goal is to convert them into paying members once they're old enough.
That's the idea. We'll get the hard conversion data in Q4, but it's clear the program has built a huge brand loyalty with the next generation of gym goers.
And it seems like actually building these new gyms is getting a little bit easier, too. They mentioned some tailwinds from retail real estate.
Yeah, that was an interesting aside. For the first time in years, there was actually negative absorption of shopping center space, which basically means more good locations are opening up for them. And they said rent increases have been moderating, sometimes even below the rate of inflation.
So it's cheaper and easier for franchisees to expand.
Exactly. It removes a major bottleneck and really helps the unit economics.
So if you tie all these threads together, the Q3 results weren't just a good quarter. They were a validation of this entire multi-year strategy. And that's reflected in the guidance they put out.
A huge vote of confidence. They raised all their full year 2025 targets significantly. Revenue growth went from around 10% to now 11%, adjusted EBITDA growth from 10 to 12%, and the big one, adjusted EPS growth, they boosted it from an 11 to 12% range all the way up to 16 to 17%.
That's a massive jump, and that led right into their investor day, where they laid out the even longer-term picture.
Yep. For 2026 through 2028, they're targeting low double-digit revenue growth every year, mid-teens EBITDA growth, and 6 to 7% annual unit growth. The whole narrative has shifted. PLNT isn't a reopening trade anymore. It's being viewed as a durable, asset-light consumer compounder.
And the sell-side analysts are buying it.
They are. We saw a bunch of price target raises, many into the 120 to 139 range. Yeah. The only real watch item now is that valuation. I mean, it's trading in the mid-30s on a PE basis, which is pretty rich.
All right, let's get to our segment that is, and we must stress this, explicitly not financial advice. We want to look at a high risk, high reward, but structurally plausible trade idea that comes out of this whole narrative.
Right. And the narrative is clear. Management has massive confidence in that $29.99 Black Card price hike. They think it's going to be a huge win for their long-term AUV.
But that optimism is now, you could argue, fully priced into the stock after that 12% jump.
It is. So the setup is this. The stock is now priced for near perfect execution. That makes it vulnerable to any disappointment, right? If the Black Card adoption is slower than expected, or if the macroeconomy weakens and consumers pull back, the stock could get hit.
So if you're a true believer in the long-term story, the unit growth, the pricing power, but you think the stock might just tread water for a bit while this all plays out, what's the move?
This is a high conviction play that the floor for the stock has been permanently raised. You could look at a short put ladder option strategy structured to bet on the stock consolidating above its old support levels through mid-2026.
Okay, break that down for listeners who might not be deep into options. What does a short put ladder actually do here?
In simple terms, you're trying to monetize the market's fear. The stock is high, the options are expensive, which means implied volatility is high. You're essentially betting that the stock won't crash. You construct a trade where you receive a credit so you get paid up front by selling some puts and buying others for protection.
So you're not betting on it rocketing higher from here.
No, you're betting on stability, you're betting it holds its ground, stays relatively high, and you profit as that rich options premium just decays away over time. It's a very aggressive bet on durable stability funded by the market's own fear.
An aggressive bet that management's guidance is a solid floor, and the market will let the stock consolidate while this pricing story matures.
Precisely. It assumes that floor is solid, and you don't need another 10% rally tomorrow to make money.
So wrapping this all up, what's the final takeaway? The Q3 call proved that Planet Fitness is making the turn. They're moving from just a volume play to a real pricing-driven compounder using data and AI to justify a premium valuation.
I think so. And for me, the one thing to watch over the next year is that $45 million shift in marketing. That's the big pivot. The real question for the long term is, can their AI and their CRM really make members stickier? Can it lower churn enough to unlock even more margin than the market is already pricing in? If the answer is yes, this valuation could still look reasonable down the road.
And a final reminder, this analysis is based entirely on public filings and our interpretation. It is not and should never be taken as investment advice. Always do your own research and maybe think about what that $5 price hike means for the lifetime value of a Planet Fitness member.
Thanks for joining the deep dive.
We'll catch you on the next one.